Yeah, good morning, everyone. This is Dr. Sarita, Assistant Professor of Commerce from BRAOU. So today our topic is first I'll share you the syllabus, then you will have an idea of what we are going to learn today. So in our yesterday's class, we have done with the Indian financial system and overview, financial services, types of financial institutions, what is money market, what is capital market, and what is venture capital, and what are the different instruments of money market and also capital market. We have learned all this, and today we are going to learn about capital market. So, what are the recent developments of capital market? And after that, we are going to learn about money market. Then we will also learn foreign exchange and derivative market. So from block 2, we are going to learn about capital market. So what are capital markets? So first, who are the participants in financial market? And yesterday we have learned about the participants of capital markets also. Debenture trustee, credit trading agencies, and everything. So a brief summary about what we have learned yesterday is that about financial system, and financial system comprises set of subsystems of financial institutions, financial markets, and financial instruments and financial services, which help in the formation of capital. So it is well said that a well-knit financial system indicates the economic growth and development of any country, and it is a means which the savings are transferred into investment by mobilizing the surplus funds from the individuals and institutions and utilizing them effectively for productive purposes, and the whatever the returns which arrived on the productive purposes will be used for welfare of the people. Okay, so financial markets may be defined or described as any marketplace where buyers and sellers participate in the trade of financial assets such as equities, bonds, currencies, and derivatives. So financial markets are very well characterized by transparent pricing, basic regulations and trading, cost and fees, and it determined by different market forces. So the financial markets can be broadly divided into money market and capital market. The subdivision of financial market or money market, capital market, derivative market, future market, insurance market, and foreign market, exchange market. And we have also learned about the role of participants in the capital market and as well as financial markets also. So yesterday we have learned a role of participants in the capital markets with different roles were discussed of stock exchange, broker, sub-broker, custodians, depositors, depository participants, and clearing. What is the role of clearing house, information providers, merchant bankers, and debenture trustees. Debenture trustees. So in that today we are going to learn about factors. So a factor is a financial intermediary that produces the receivables from a company at the invoice price or less a discount for commission and fees. Okay, then it advances up to 80% of the value of the receivables of the company immediately, and the balance amount is paid after the receipt of funds transferred from the debtor. Thus, it is difference between the invoice face value and the advance serves as a reserve account, which serves to reduce the risk for the factoring company. So factoring normally referred to as accounts receivable factoring, invoice factoring, or accounts receivable. So financing is a financial transaction between the company, seller of the receivable, and the financier, called factor, in which a business firm sells its accounts receivable at a discount, mostly to meet its immediate cash needs. Okay, so factoring is the financial service provided by the specialized financial institutions relating to the management and financing of debts of the company. So here in factoring, there are three parties directly involved. One is the seller, and another one is the debtor, and the factor. So the firm is the seller of receivable, usually at a discount to the third party. So he is also called as financial intermediary. So the debtor is the one who has to make payment to the owner of the invoice. Okay. And the factor is the one who purchases the receivable. So the debtor makes the payment to the owner, and the factor is the one who purchases the receivable. So factoring company charges a fee called discount rate as a percentage of the face value. Okay. Then for services which are rendered by the factoring company, they'll charge some fees. That fees is called as discount rate as a percentage of the face value. So on the receivable is sold to the factor, ownership of the receivable is transferred, and thus the receivable becomes the factor asset, and the factor has all the rights to receive the payment from the debtor for the invoice amount and can pledge or exchange the receivable assets without any restriction. So in this, the full liability of the debtor is assumed by the factor, and the factor has the right to take any legal action required to recover the debt. Okay, so factoring can be with recourse, where the loss on account of non-payment of the invoice amount by the debtor will be borne by the seller of the receivables, and thus the unpaid, whatever the unpaid amount is there, that unpaid amount can be recovered by the factor from the transferor or without recourse, wherein the factor has a bear the loss on account of bad debt. So here, in simply, we can say that a factor is a financial intermediary that purchases the receivables from a company at the invoice price. So any extra interest, whatever is there, or less invoice price or less than the invoice price, which we can say it as discount or for commission and fees. Okay. So it advances 80%. So if the debtor is in debt to the company and the company is in need of money, what the company will do? The company will simply as it may mortgage its debtors receipts to the factoring company, where the factoring company takes or purchases the receivable at same invoice price or discounting price, and 80% of the value of the receivables to the company immediately, and the balance amount immediately paid to the company, and then and after the receipt of the funds from the debtor, the difference will be paid. So whatever the headache is there by collecting the debt from the debtor, that will be transferred to the factoring company. So it is like an agency. We have purchased our vehicle or car from ICICI Bank. Then ICICI Bank can be authorized its powers to some agency to collect the money from the customers. So for that, they will be paid some commission, or whatever the interest difference amount will be there, that will be taken by the company. So the same kind of services is also provided by factoring company, where factoring company purchases the receivable from a company at invoice price or at same price, and it advances 80% of the amount, and then after payment made by the debtors, the remaining difference amount will be paid to the company. So this is called factoring. Actually, factoring commonly referred to as account receivable factoring, invoice factoring, or account receivable. Then financing is a financial transaction between the company and seller of the receivable. Okay. For to meet the immediate cash needs of the company, the company may approach to the factoring institution, where the factoring provides the financial services provided by the specialized financial institutions relating to the management and financing of the debt of the company. So in factoring, it involves three parties. That is, one is seller, debtor, and the factor. So seller, the debtor is owed money to the seller, and due to the immediate requirements or meeting the financial needs, the seller will give its debt receipt to the factoring company, where on behalf of seller, when factoring company collects the money, for that the seller may buy the receipt invoice at invoice price, receivables at invoice price, purchases the receivables at invoice price or less than a discount price, or they will charge some fees. So these factoring companies or factoring institutions are financial intermediaries, which is linked, which acts as a link between the seller and debtor. Then, so when the receivables are sold to the factor, ownership of the receivable is transferred to the factor. So these receivables are sold by the company to the factor, and immediately the ownership of the receivables is transferred to the factor. So thus the receivables become factor assets, and the factors has all the rights to receive the payment from the debtor. So the full liabilities of debtor is assumed by the factor. So here, when the company sold its receivables to the factor company, so the receivables becomes the factor's assets, and the factor has all the right to receive the payments from the debtors for the invoice amount, and can pledge those payment receivable or exchange the receivable asset without any restriction. So factoring can be with recourse when the loss on account of non-payment of the invoice amount by the debtor will be borne by the seller. So when the debtor has not paid the amount after pledging the receivables to the factoring company, then the whatever the loss is there, that should be borne by the seller. So next, now this is about factoring, all about factoring, and we have their different components of factoring. So components of factoring, commission fees paid to the factor, interest on the money advanced by the factor. Then we have bad debt expenses on account of unpaid amount by the debtor. Then factors hold back receivables amount. The factor's overall profit is the difference between the price paid for the invoice and the money received from the debtor. The business consent would be go for factoring if the return on the funds released instead of getting blocked in the account receivable. When these business houses will go for factoring, when if the return of the funds released instead of getting blocked in the account. So some commission, discount or fees payable to the factor or the services. So what are the advantages of factoring? So the main advantage of factoring is quick boost to cash flow. So it will quick boost to cash flow, thus serving the working capital requirement of the company. So when the funds are blocked in the form of debt in data, so then to meet the urgent requirements or working capital requirements, normally the business houses will go for factoring. So the main advantages of factoring is to quick boost the cash flow. So thus the working capital requirement, thus by going for factoring, the factoring institutions will pay 80% of cash, whatever the debt is there to the companies, business houses, and with that immediate 80% of amount, they will meet the immediate requirements of companies' working capital or any other needs, financial needs. So the headache, whatever the headache which carried out by the business houses to collect the money from the debtors, that will be transferred to the factoring company. So now the factoring company will collect the amount, and these companies will pledge the um, receivables to the factoring company, and immediately the ownership on those receivables will transfer to the factoring company. So here the factoring company will work or will provide its services on the basis of commission, or some they will collect some fees, or they purchase the receivables on same invoice price, and after that they may charge interest from the debtors for late payment, and the extra commission may be paid to the factoring company. So here the factoring company will charge some commission or any extra payment from the business houses whose receivables have been pledged to the factoring company. And if after repeated requests to the debtors for payment, if they are bad debt, the debtors are not turned up for payment of those receivables, then whatever the loss is there, that loss will be borne by the seller. So, and again, one more advantage is a competitive pricing is offered as there are many factoring companies. So there are many factoring companies are existing. So a competitive price will be offered to the seller companies for providing the services. So availing factoring services enables the company to spend its time on managing the business and reduce its administrative cost. So usually this all the headache will be transferred to the factoring company. So the business houses may concentrate or spend their qualitative time on managing the business and reduce its administrative cost also. So the fact that the sales ledgers are sold to the factors, customer may respect and pay more quickly. So when the sales ledgers or receivables are sold to the other factoring company, so the customers may feel little bad when the other company, intermediary company is asking money to them instead of seller. So the customers may also feel respect and pay more quickly to the seller. So in the case of non-recourse factoring, the company is protected from the bad debt. So non-recourse factoring is there. Usually the company will be protected from the bad debt. So immediate advance of cash to the extent of 80% is released by the factor, and thus the company can go for capital investment and funding next order. So immediately the amount will be paid to the company's business houses after pledging this receivables to the factoring company. So whatever the time will be saved, and the business houses can concentrate on managing the business and administration. So it is also one of the big advantages, and where the company can go for immediate capital investment may use the money, 80% of bad debt or debtors, the receivables amount will be paid by the factoring company at the uh, advantage prices. Then the company may also use those funds for investments and for further next orders also. So useful information provided by the factors relating to the credit standing of the customers can help the company to trade with better quality customers and thus improve the data spread. So whatever the information which are provided about the customer to the company, now the company can manage to whom they have to give the products on credit. So thus the companies may know the quality customers and thus they can improve the data spread. So these are the advantages of factoring. Now, what are the disadvantages of factoring? So factoring through offers benefit to the seller of receivables. It has disadvantages too. So the cost of discount to be paid to the factor will result in a reduction in the profit margin. So here sometimes the factoring company may purchase the receivables at invoice price or at discount price, and they may bargain with the company. So here, so the companies have to discount, pledge their receivables at discount price because it may result in the reduction in the profit margin. So the relationship between the company and debtors may deteriorate due to the harsh techniques adopted by the factors for the recovery of debt. So when the third party is involved, actually there may be a harmonious relationship between the debtors and the company, but due to the harsh techniques adopted by the factors to collect the debt from the debtors or recover the debt from the debtors, that may deteriorate the relationship between the company and debtors. So this is also one of the main disadvantages of factoring. So the new companies does not get the benefit of factoring, as factor purchases the invoice of a reputed company only. So the factors will purchases the invoices of a reputed companies only. So the budding companies or the new companies will not reap the benefit of factoring. So then the image of the company may suffer, as factoring may be viewed as a sign of inefficient and ineffective management of the company. So when the bad debt increases, it may give a negative impact on investors, shareholders, that the company is not able to manage manage its activities effectively. Then only the company may approach for factoring. So in market, when the business houses will go for factoring, it may give negative impact in the market. So due to that, the image of the company may suffer, as factoring may be viewed as a sign of inefficient and ineffective management of the company. So the business planning has to be done in advance. If the company wishes to end an arrangement with a factor, as the money advanced on invoices has to be paid off if the customer has not paid them yet. So whatever the 80% of invoice has been received by the company, if the customer fails to pay that amount, then the company has to pay the amount and the company has to arrange the amount in advance to pay to the factor company. So this is also one of the main disadvantages that has to be seen while factoring the invoices to the factoring company. So therefore, before going for factoring, any business houses must analyze the above, whatever now we have learned the pros and cons, and should take decision accordingly. So I hope you have learned about what is factoring, what are the different components of factoring, how the factoring is done, when the business houses will approach for factoring, and what are the impact of factoring in the market in the form of disadvantages, and what are the advantages of factoring also we have learned now. Now next we are moving to the next block, that is block 2, about capital markets. So yesterday we have learned a brief about capital markets. Okay. So a capital market, the market where investment instruments like bonds, equities, and mortgages are traded. It is known as capital market. So we have two types of capital market. One is primary market and another one is secondary market. So the primary role of this market is to make investments from investors who have surplus funds to the ones who are running a deficit. So those who have surplus funds, that will be mobilized by the capital market, and where the deficit is there, that funds will be used by them. Okay, here, so Indian financial system accelerates the rate and volume of saving through provisions of various markets. Okay, mainly financial intermediaries play a vital role in bridging the gap between the investors and the borrowers. So this help in the productive use of surplus money of the society, investors. So there are various types of financial intermediaries, which comprises of both organized and unorganized sector. In organized sector, the state-owned financial institutions, banks, mutual funds, organizations, insurance companies, non-banking financial institutions, investment companies, financial intermediaries we have. And in unorganized sector, money lenders, indigenous bankers, chit funds, nidhi, these all fall under the category of non-organized sector. So here, the capital markets are the market that channels saving and investment between supplier of capital, retail investors and institutional investors, and the users of capital, businesses, government and individuals. So they are the market for buying and selling the equity and debt instruments. So in capital markets, buying and selling of equity and debt instruments take place. The capital markets have numerous participants, which can be categorized as individual investors, institutional investors, like pension funds and mutual funds, municipalities and governments and companies and organizations, banks and financial institutions. So there are so many participants in capital markets. So before learning about the capital markets, we need to understand who are the participants of capital markets. So first is stock exchange. The stock exchange is duly approved by the market, by the regulators, where purchase and sale of dematerialized securities, equities, bonds, and derivatives take place on behalf of the investors through brokers. It provides clearinghouse facilities, guaranteeing all payments and deliveries. So some of the major exchanges are New York Stock Exchange. In India, we have Bombay Stock Exchange, in NASDAQ. And the actual trades take place on the auction market model, where a potential buyer bids a specific price for a stock and a potential seller asks a specific price for the stock. And when the bid and ask price match, a sale takes place. So in the capital market, auction market model will take place, where the potential buyer who is interested in buying the stock shares of the companies or debentures of the companies, they'll bid for a price, and the seller asks for the price, bid and ask for the price. When this buyer and seller bid price has been matched, then a sale takes place. So this is what happens in stock exchange. So the capital market offers both long-term and overnight funds. So the different types of financial instruments that are traded in the market are equity instruments, credit market instruments, uh, insurance instruments, foreign exchange instruments, hybrid instruments, and derivative instruments. Derivative instruments are also called as commodity markets, commodity instruments. So now, what is the role of broker in the capital market? So, broker is a person who acts as an intermediary between the buyer and seller of securities. So, their duty is to help in building up order book, price, discovery, and see to it that the contracts entered into are honored. Okay, the fee of the service rendered is called brokerage. Whatever the services which are rendered by the broker and the fee paid to the broker is called brokerage. And to operate on a stock exchange as a broker, they need to be approved brokers by the SEBI. So Securities Exchange Board of India will approve them as brokers. Then only they are eligible to act as a broker in the capital market. So the capital market regulator, however, the broker will not hold any inventory. So here, broker will act as only intermediary between the buyer and the seller of securities, and they have to get approved by the SEBI to act as a broker. They'll be paid some commission or some price for their services rendered, and that amount is called as brokerage. So here, brokers will not hold any inventory. Their duty is to maintain and help in building up order book. So then the next category of broker is sub-broker. So sub-broker is a person who assists the investors in dealing in securities by acting on behalf of a trading member as an agent, and he is not a trading member of a stock exchange. So in order to deal in securities, all the sub-brokers has to required to obtain a certificate of registration from SEBI. It is a mandatory for the members to execute with all the sub-brokers. So an agreement specifying the rights and responsibilities of members as well as brokers. So next is custodians. It is also participant of capital market. Knowing about capital market, we should know all the participants who are in capital market and their role. Okay. So the next one is we have custodians. So these are the organizations like banks supervised by the SEBI, which hold the securities. Here, brokers and sub-brokers will not hold the securities, but custodians will hold the securities on behalf of buyer or customers. Okay. On behalf of customers, they will carry out the operations like payments and settlements relating to the securities. So they handle both funds and securities of qualified institutional borrowers, including foreign institutional investors. So the nature of capital markets, it has two segments. It deals in long-term securities. It performs trade-off function, and it creates dispersion in business ownership. It helps in capital formation. It helps in creating liquidity. So now the depositors, after knowing about the nature of capital markets, and one more participant is depositors. So depositor is a person or a company to whom securities are entrusted for safekeeping and handling, dealing in them on behalf of the owner of security. So a depository transfers securities from buyer to seller's accounts in electronic form on instructions of stock exchange clearing house only, after supported by documentation. So here depositors will safeguard the securities, they'll handle They'll interested for safekeeping and handling dealing on behalf of owner of the security. So when they get clearing from the stock exchange clearing house clearance, after submitting the supported by the documentation, the depositors will transfer the securities from buyer's account to seller's account in an electronic form. So the services are classified into four services and special services. The services which are provided by the depositories are classified into four services and special services. So the various core services are account opening, freezing and closing, transmission and nomination, dematerialization and rematerialization, trading and settlement, and the special services provided by Indian depositories are pledge and hypothecation, stock lending and borrowing, corporate action, public issues, debt instruments, and government securities in DMART form. So NSE, KVP in DMART form, warehouse receipts, market participants and investors database and tax information network, etc. So here, what is the role of clearinghouse? It settles the obligation for the respective counterparties on maturity of the trade as well as during their tenure. When any person or any investor need money, they can hold or sell the securities, and for that, the clearing house will see that the obligations are settled for the respective counterparties, and on maturity of the trades as well as during their tenure, the trades done through exchange have very low settlement rates. So then information providers, these are the Reuters or Bloomberg are the major informative providers across the world for financial data. Reuters and Bloomberg are the major information providers. So live information on prices and market movement and historical quotes for all exchanges, newsroom information, technical charts, financial analysis, etc. will be provided by the information providers. So these help business houses as well as the investors to have check on their securities, shares, and how the shares are trading in the market. So these help the market to maintain transparency by providing reliable information to the investors on the basis of which they can take decisions. So now again, merchant bankers, they are the agencies, organizations regulated and licensed by the SEBI. So we are discussing about the participants and their role in the capital market. We are discussing about the capital market. So the merchant bankers, they are the agencies and organizations regulated and licensed by SEBI. They advise the companies on book building, pricing of issues, arranging registrars, and bankers to the issue, help in arranging for raising of funds through equity, debt, underwrite the issue, act as issue managers, assist the companies in preparing and filing out the various documents and other compliances with the regulators. So the main role of the merchant banker is raising funds through equity and debt and underwrite the issues, act as an issue manager, assist the companies in preparing and filing of various documents and other compliance with the regulators. So these all participants in capital market help the investors as well as the business houses to how to trade their securities and how to buy the securities in the stock exchange, what are the documents needed, how to the clearing house mainly settles the obligations for the respective counterparties, and the depository will safeguard and safekeeping and handling the securities dealing on behalf of owner of the security. Then bankers to the issue. The next participant is bankers to the issue. So bankers to the issue perform a collection of all activities such as submission of application, collection of application money, from the investors and transfer of funds to the escrow account, date on which the application is being received, and date on which the refund is done to the investor. So all these information will be provided by bankers to the issue. So bankers to the issue are appointed in all the mandatory collection centers, which are specified as Disclosure and Investment Protection Guidelines 2000. In Disclosure and Investment Protection Guidelines 2000, all the issues, banks to the issues are appointed in all the mandatory collection centers, which is clearly specified in D. So now we are going to understand about underwriters. Who are underwriters? So they guarantee, what is the work of the underwriters? They guarantee the corporation to buy all the securities on offer at an agreed price. If people do not subscribe to the same for which they charge underwriting fees, using their distribution chain, they will sell these shares in the market for a higher price, making a profit. So usually when the new companies will start, so they'll go for underwriting, and underwriters will guarantee the corporation that to buy all the securities on offer at an agreed price. If people do not subscribe for the same, they'll take the charge as sellers. They charge underwriting fees, and using their distribution chain, they'll see and they'll help the corporations that their shares in the market will be sold for a higher price and making a good profit for the business houses. So this is the role of underwriter. The next is registrations to the issue. It is an institution, a bank or a trust company, which plays an administrative role in conducting a public issue. It maintains records of shareholders and bondholders. When an issuer sells securities to the public and a dividend payment to the shareholders or an interest payment on a bond would be made only to those whose names are found in the list. So they will register the name. They'll maintain one register at the registrar office, and they advise the company regarding the closure or extension of closing date of the issue. So registrars of the issue will play a major role with an administrative role in conducting a public issue. They maintain records of shareholders and bondholders when an issue sells securities to the public and a dividend paid to the shareholders or an interest paid on a bond would be made only to those whose names are found in the list of registered owners maintained by the registrar. So the administrative help will be provided to the companies, and they advise when the closure or extension of closing date of the issue takes place. So directly and indirectly, they'll help the companies for administrative purpose. So they maintain the list of the shareholders and bondholders, and when the payment dividend has to be made or when the interest has to be paid to the bond, they'll see that the correct persons should get the benefit, the interest or dividend, and they will intimate the companies of closure dates and everything. Then next is portfolio manager. So who is portfolio? He is also one of the participants in capital markets. He is a person, portfolio manager is a person or group of people responsible for investing in mutual, exchange, traded or closed-ended fund assets, implementing its investment strategy and managing day-to-day portfolio trading. He helps in deciding the customized investment solutions for an individual as per his income, age, as well as ability to undertake risk. So the portfolio manager will will held responsible for investing a mutual exchange traded or closed-end funds assets. Then mutual funds. Mutual funds are the organizations which mobilize the small investors and invest their money in stocks. Small investors and invest their money in stocks. So they see that the small investors also invest their money in the stocks, bonds, and other securities. The financial risk of the investment belongs to the investor. Each investor owns units which represent a portion of the holding of the fund. The fund charges a small fee for managing the fund. So the role of this mutual fund is they will mobilize the savings from small investors, and they see that the investment will be invested in a proper companies where the dividends can be reaped well, and they manage the uh, funds of the investors, and the financial risk of the investment belongs to the investor also. So each investor owns units which represent a portion of the holding of the fund, and these mutual funds charges a small fee for managing the fund. So now debenture trustees. These trustees mean a trustee of a trustee, a scheduled bank carrying on commercial activity, or a public financial institution, an insurance company, or a body corporate who is responsible for issuance and distribution of debentures. So these trustees serve as a liaison between the company that issued the debenture and the debenture holders that are collecting interest payments. So trustees will work as they may be as scheduled banks carrying on commercial activity, a public financial institution, or an insurance company or a body corporate. These debenture trustees are responsible for issuance and distribution of debentures. So here debentures means a loan divided in small parts. The trustee serves as a liaison between the company and the debenture holder who has provided loan to the company, and they make sure that the interest paid by the companies to the debenture holders should be formed. They'll act as a liaison between the companies and also debenture holders. When the companies will call for the debentures, they'll issue a debenture certificate to the debenture holders, and on debenture, the holded by the portion of debenture holded by the debenture holders, they will be paid interest by the company. So these debenture trustees will make sure to see that the company should pay a prompt and time to time interest payment to the debenture holders. So this is the main role of debenture trustees. They are also participants of capital markets. Now we are going to learn about the credit rating agency. So credit rating, these are the independent professional bodies or firms or organizations which rate the ability of a person or company to pay back a loan. As we see that whenever we go for a loan to the bank, we approach a loan to the bank. The bankers first will check our CIBIL score. CIBIL is also one type of credit rating agency which provides CIBIL score or credit score which rates the ability of a person whether he or she pay back the loan or not. They conduct in-depth research on components and securities issued by them. These credit agencies will conduct a depth research on components and securities issued by them. So A low rating by the credit rating agency indicate a higher risk of default. So if the credit rating agency has provided low score to the individuals or any other companies, it means that, or it indicates that, a higher risk of default by the issuer, and therefore forces the company to give a higher interest payouts on the bonds in order to compensate for the risk an investor takes. So rating can be firm level rating, rating of its long-term debt, rating of its short-term debt. The global players in credit rating are S&P, Fitch, and Moody's. So these three, there are so many credit rating agencies are there, but the main global players in the market are S&P, Fitch, and Moody's. So these credit rating agencies provide credit score to the companies or persons for the ability of a person or company to pay back a loan or not. So next is venture capital market. So in this, there are investment funds that manage the money of investors who seek private equity stakes in startup and small to medium-sized enterprises with strong growth potential. So these venture capital markets will provide capital to the budding companies. Sometimes the innovative ideas were provided by the individuals, but they are deficient or lack of capital. So these venture capital funds will act as a mediator or link between the investors and the idea makers. So when the idea has been taught to the investors, it's those investors who want to seek private equity stakes in small startups and small to medium-sized enterprises, these venture capital marketing will help them to get the capital, and this leads to a strong and growth potential. So these investments are generally categorized as high risk, high return opportunities, because investing in a small budding company may be a risk for the investor without having any background of experience or anything. The money which is invested by the uh, investors in those companies may fall in a high risk. As we have seen the program in Sony, Shark India. The Shark India is also the way the entrepreneurs, the big successful entrepreneurs are coming and knowing the ideas of small budding entrepreneurs, and they are investing their money in their business in return of their equity. So that is venture capital marketing, venture capital funds role mainly, and they are also the participant of capital market. Now, then the next and last is market maker. So market maker is an intermediary who is willing and ready to buy and sell securities and create a market for securities by providing a two-way quote in the market, and thus ensures liquidity and efficiency in the market. So market makers buys from the seller and later during the day sells the securities to the buyer. So the bid-ask spread is his earnings. The more liquid the security, the narrower is the bid-ask spread. So thus market makers help to create. So these all are the participants in role market, and their role we have learned in capital market. So in capital markets, we have primary and secondary markets. Okay, in primary markets, yesterday we have learned what is the role of primary markets. Okay, so capital market is one of the significant aspects of every financial market. It is a market where financial securities are traded. In brief, so to promote the capital market and protect investor interest, the SEBI has announced several far-reaching reforms in the capital market. Reforms in secondary market have focused on three main areas: structure and functioning of stock exchanges, automation of trading and post-trade systems, and the introduction of surveillance and monitoring systems. So next, we are going to learn about money market. So what is money market? So there are two types. One is capital market and one is money market. Okay. So money market is the now center of the financial system. It is the market where the short-term funds will be provided. It provides the funds for less than a period of 1 year. Money market mobilizes saving from different sources and makes them available for investment. It deals with the buying and selling. It deals with the buying and selling of it deals with the buying and selling of short-term instruments such as treasury bills, commercial papers. Then money market is a market which meets the short-term requirements of borrowers like financial institutions and government. So according to Krothar, the money market is a name given to the various firms and institutions that deal in the various grades of mere money. Okay, so according to RBI, money market is a center for dealing mainly of short character in monetary assets. It meets the short-term requirements of borrowers and also provides liquidity or cash to the lenders. It is a place where short-term surplus investable funds at the disposal of financial and other institutions and individuals are bid by borrowers. So the main importance of money market is financial trade and financing industry. So features of money market: it is a market for borrowing and lending of short funds. It deals with short-term instruments which can be easily converted into cash without loss and at a minimum cost transaction. There is no formal place to conduct these operations. The transactions take place mostly through phone. So the transactions in money market are dealt without the help of brokers. So we have different types of money market: call money, commercial bills, treasury bills, etc. So the participants of money market are central banks, commercial banks, non-banking financial companies, discount houses, and government. So the main objectives, money market mutual funds are also there. So the main objectives of money market is to provide an opportunity or a place to employ short-term surplus funds needed, and to provide a place to overcome short-term deficit, to provide access to the users of short-term funds to meet their requirement at a reasonable cost, then to enable the central bank to influence and regulate liquidity in the economy through its intervention in the market. It helps to central banks. It formulates of effective monetary policy. It helps in formulating effective monetary policy. And there are different non-banking institutions also. And who are the players of money market? The players of money market are government, Reserve Bank of India, and commercial bank. Government, Reserve Bank of India, and commercial bank. So financial institutions, corporate firms, and dealers. So they all are the players of money market. So first, going to learn about the money market, we need to understand the actual meaning and definition of money market. So what is the definition of money market? Money market basically refers to a section of the financial market where financial instruments with high liquidity and short-term maturities are traded. So when there is a short-term fund deficit, Then the money market plays a major role in providing that short-term loans or short-term funds to the users. So money market has become a component of the financial market for buying and selling of securities of short-term maturities of 1 year or less, such as treasury bills and commercial papers. So money market is a nerve center for the financial system. It is a market for short-term funds. It provides funds for less than a period of 1 year. Then money market mobilizes the savings from the different sources and makes them available for investment. This money market mainly deals with buying and selling of short-term instruments such as treasury bills, commercial papers, etc. So it is a place which meets the short-term requirements of borrowers like financial institutions and governments. So next, what are features of money market? So features of money market. The whole description about money market is money market consists of negotiable instruments such as treasury bills, commercial papers, and certificate of deposit. It is used by many participants, including companies, to raise the funds by selling commercial papers in the market. And the government, whenever it is in urgent need of money, they'll also trade the bonds and everything in the money market. So money market is considered as a safe place to invest due to high liquidity of securities. So money market is center for mainly dealing of short character in monetary assets. So it meets the short-term requirement of the borrowers and provides liquidity or cash to the lenders. So the money market is an unregulated and informal market and not structured like the capital market where things are organized in a formal way. Money market gives lesser return to the investors who invest it in but provides a variety of products. So it is an unregulated market which where the short-term surplus investable funds are the disposable of financial and other institutions. And the importance of money market is financial trade. Money market plays crucial role in financing both internal as well as international. So commercial finance is made available to the traders through bills of exchange, which are discounted by the bill makers. So financing industry, money market helps in securing the short-term loans to meet their working capital requirements through the system of financial bills, commercial papers, etc. So it is a market for borrowing and lending short-term funds. So it deals with the short-term instruments which are having maturity period of 1 year only, very short period. Then what are the money market instruments? So call money market, commercial paper, treasury bill, commercial bill, certificate of deposit, money market mutual funds, the repo market, discount and finance house of India. So these are the instruments of money market. So the main functions of money market is maintains monetary equilibrium. So a developed money market play an important role in supplying adequate short-term funds to the agriculture, infrastructure, trade and industry. And it is an important factor for the development of an economy of a country. The main function of money market in smooth functioning of the financial system in any economy. And first one is money market maintain monetary equilibrium. So it helps to maintain demand and supply equilibrium with regard to the short-term funds. Then financing trade and industry is important source of financing commercial enterprises. on short-term basis. It plays a crucial role in financing both domestic and international trade. So usually traders use bills of exchange for their short-term requirements. The bills are discounted by the bill market. The activities in the international trade are carried out by the acceptance house. So they also influence the capital market. So the long-term requirements of the trade and industry are met through the capital market, whereas the short-term requirements are met through the money market. So, and short-term rates of interest will have an influence on the resource mobilization and interest rate in the capital market. Hence, the development of capital market depends upon the existence of a developed money market. So, it is an ideal investment for commercial banks. Sure, this money market is an ideal investment for commercial banks, where the surplus money of the customers held by the commercial banks can be deposited in money market, and where they can get good interest. So the functions of commercial banks is to accept deposits from the public and advance loans to the borrowers. Sometimes what happens is the commercial banks may have surplus funds, and in such instance, the money market provides an ideal opportunity for the commercial banks to deploy its surplus funds in easily realizable assets so as to meet its statutory reserve requirements, CRR and SLR. So here the banks can make good profits from its surplus funds. Besides this, the money market provides liquidity to the investors made by the commercial banks. So the whatever the surplus which are held by the commercial banks, that surplus funds can be deposited in the money market for a short period of time, and then they can get good interest and they can make good profit on surplus funds. So the money market helps the central banks also. So the existence and development of money market smoothens the functioning of the central bank. So the money market increases the efficiency of the central bank through implementation of monetary policy. The short-term interest rates in the money market enable the central bank to adopt an appropriate banking policy. So by adopting an appropriate banking policy, the money market enables the central bank to adopt and to implement those appropriate banking policy by meeting the short-term requirements of different banks. So bank through implementation of monetary policy and the short-term interest rates in the money market also help the central bank. So then non-inflationary source of finance the government. So the money market also helps the government to raise funds at low cost through the issue of treasury bills. The government has the borrowing capacity from other modes which are inflationary in nature. So a developed money market helps the government to raise the short-term money requirement, short-term fund requirement at low cost through the issue of treasury bills. So treasury bills will be issued by the government, and on that with low cost, the government can meet their short-term deficit fund requirements through money market. So the money market will also help in formulation of effective monetary policy. The money market helps the government in formulating and revising a monetary policy depending on the conditions prevailing in the market. So these are the functions of money market. And now what is call and notice money market? So the market for extremely short period is referred as call money market. Under call money market, funds are transacted on overnight basis. Funds are transacted on overnight basis. So the participants are mostly banks. Therefore, it is also called as interbank money market. Under notice, money market funds are transacted for 2 days and 14 days period. The lender issue a notice to the borrower 2 to 3 days before the funds are to be paid. So on receipt of notice, borrowers have to pay the funds. In this market, the rate which funds are borrowed or lent is called call money rate. So the call money market accounts for a major part of the total turnover of the money market. So the call money rate refers to the market for a very short period, loans ranging from 1 day to 14 days. If the amount is borrowed for 1 day, it is called call money. If the period is more than days and up to 14 days, it is called notice money. So call money and notice money are there. If the money is borrowed for 1 day, it is called call money. And it is more than 1 day and up to 14 days, it is called notice money. If it deals with the funds for 15 days to 1 year, then it is called term money. So these three different. For 1 day, it is called call money. And for more than 1 day and up to 14 days, it is called as notice money. And if it is if it deals with funds for 15 days to 1 year, it is called term money. So these market enables banks to even out their day-to-day demand for the supply of short-term funds. It is purely unsecured market where no collateral security is and supply of where there is no collateral security is required for securing the funds and there are no brokers involved. So the settlement, whatever the settlement is done between the participants through the current account maintained with the RBI. The low transaction cost, the ease of transacting the same day settlement of funds act as strong incentives for the banks to assess the call money market for managing intraday funding and CRR requirements. So this market is a highly liquid market and highly risky as it is extremely volatile. So this is about call and call money market. So who are participants in call money market? So during 1930s and 1960s, the interbank call money market was the core of the Indian money market. In 1971, the LIC and UTI were permitted to lend in the call money market and no brokers were permitted in the market. And in the year 1985, yes, Chakravarti Committee recommended that additional non-bank participants may be allowed to participate in call money market. And as a result, General Insurance Corporation of India, IDBI, Industrial Development Bank of India, National Bank for Agriculture and Rural Development, NABARD, primary dealers including Discount and Finance Houses of India and Securities Trading Corporation of India, mutual funds were also permitted to participate in this market as lenders. So primary lenders were also permitted to operate both as lenders as well as borrowers in this market. So the Narasimhan Committee in 1988 on banking sector reform recommended that they should be strictly restricted to the bank with the exception of PDs. Then following the recommendations, the RBI gradually introduced the significant changes in phase manner for moving towards pure interbank call money market. So the participants in the call money market currently included scheduled commercial banks excluding RRB. RRBs are not participants of call money market, cooperative banks other than land and development banks and primary dealers. So now the RBI has stipulated prudential limit on the exposure of commercial banks in call or notice money market. Lending of scheduled commercial banks on a fortnightly average basis was capped at 25%. So only 25% can be lending has to be done to the commercial bank fortnightly of their own funds. However, banks were allowed to lend a maximum of 50% on any day during a fortnight. So similarly, borrowing by scheduled commercial banks were accepted at 100% of their own funds or 2% of aggregate deposits. So whichever is higher. However, banks were also allowed to borrow a maximum of 125% of their own funds on any day during a fortnight. So now the RBI is monitoring and it is allowing its commercial banks and scheduled commercial banks to participate in the money market. And the cap, it was capped 25% of their own funds And however, the banks can lend 50%. So then the RBI also stipulated prudential limits on the lending and borrowing of primary dealers in call or notice money markets. So now here primary dealers were permitted to lend and borrow in call notice or money market on average basis in a reporting fortnight up to 25% and 225% of net owned funds. So NDS, negotiated dealing system, RBI's negotiated dealing system, in the year 2002 became operational. RBI directed all deals in call or notice or term money among negotiated dealing system to the reported automatically through NDS. And if the deal was done on NDS, if the deals are done outside NDS, means negotiated dealing system, they should be reported within 15 minutes of concluding the deal. So in the year 2006, a negotiated dealing system called an electronic screen-based code-driven dealing system for all call, notice and term money. Operations was launched by Clear Corporation of India Limited on behalf of the RBI. The RBI mandated the switch in reporting of all over the counter call or notice or term money to the reporting platforms of NDS calls, which operates between 9 a.m. to 5. So this is about call and notice money market. So in simply, we can say that the call money market accounts for a major part of total turnover of the money market. So it is a market for a very short period loans ranging from 1 day to 14 days. And if if the amount is borrowed for 1 day, it is called call money. And if the amount is borrowed more than 1 day and up to 14 days, it is called notice money. And if the amount is borrowed more than 15 days up to 1 year, is called term money. So these three kinds of monies are borrowed in the money market. So banks are playing major role. RBI has stipulated prudential limit. They have capped 25% for the bank. So negotiated dealing system, RBI's negotiated dealing system has also become operational, and RBI is directed all deals in call or notice or term money amount. So this is all about call money market. Thank you.